So in this video, we're going to be talking about the final stage of the plan, the sixth video in the series of criteria for consistency. And so let's do a quick recap. So in video one, we spoke about the reversal candlesticks that would then lead to video three's SRZ zones. Video two was talking about the need to have higher time frame analysis. I'm just going over to see the videos that we've done so far. Then the fourth video was about volatility and using the ATR to set our stops and eventually targets. And finally, criteria for consistency, video 5 was about the entry model. So we've got all of that. We know where our stop's going to go. Where does our target go? How do we manage the trade? And that's what this video is going to be about. So here you see, this is an actual SRZ zone. I won't go to the 15-minute to prove it to you, but just know that this is a valid SRZ support resistance zone. It comes up. This is a valid entry. As you can see, the high here is 67.50 and the high here is 67.75. So it's a tick higher, so that satisfies that criterion. And then we use the ATR for the stop. So we're hitting all the bullet points of the videos that we've mentioned, that we've gone through so far. This is a 2-to-1. I have it at 2-to-1, means that this distance here, as defined by the ATR stop, by the ATR value, the volatility gives us our stop, and this is twice that distance in our favor if we're shorting from here. And you can see it gets there, and it really does respect these levels quite well. If you go through and do your due diligence, you'll see that it oftentimes respects those levels, comes back underneath it, goes from support to resistance and so on. 3 is at 46.25, which is right there. Again, it bounces here again. You can see wicks, close under, then wicks. So and then on this side here, support becomes resistance, at least for a bit, then turns back and becomes support. So the market does respect those chunks of volatility, those kind of multiples of the ATR volatility. But how do we go about choosing this? Well, first of all, let's read this over here. Number one, target. There are three ways you can approach this. You can get in with the target and go all in, all out. And this is what we'll use as our example when we get to these facets of the idea of trade management a bit later in this video. All in, all out means you sell here and you do nothing until it either hits this target, in my case 2R or 3R or whatever it is, or hits your stop. No trailing. Number two, a target, but you trail in some methodical fashion. And for the purposes of this video, I won't get into the different ways you can trail, except for one, which is the break-even stop. And I go break-even when I'm halfway between my target, my entry and my target, usually. So if I'm going for 2R, then I'll go break-even 1. If I'm going for 4, I'll go break-even 2, and so on and so forth. And then there is number 3, no target, and you just trail. You just keep trailing until time runs out, the end of the day, the end of an hour, or whatever your research tells you to do. Or you trail in a methodical fashion until eventually the market comes back and takes you out. So we're going to look at just number 1 for today, and you can apply these rules to the other two, like number 2, target trailing stop, and number 3, no target trailing time stop. MFE, mass favorable excursion. You need this because you need this in tandem with the expectancy. So let's go through expectancy first. E equals average win times by win rate minus average loss times by loss rate. These numbers need to give a positive expectancy, otherwise you won't make money. And it needs to be positive after commissions. So these numbers need to be after commissions. So if let's just use 2-to-1 as an example, and a 50% win rate. If my average win is 2 times we'll do it in terms of R. So average win in terms of R, average loss in terms of R, which we spoke about in a prior video. If I believe it was the ATR video, criteria for consistency 4. So if we are doing average win as 2 in this case, average loss is 1 unit, and it's always going to be 1 when measured in R. And if we've got 50% win rate, well, that's going to be 0.5. So 2 times 0.5 is 1 minus 1 times 0.5, and that's going to be 0.5, and the result is 0.5. So I hope you followed that. 2 times by 0.5 minus 1 times by 0.5. That means that's 1 in this these brackets here, that's 0.5. Take away 0.5 from 1, and you end up with 0.5. That means your expectancy, what you can expect to win over the long haul over, say, 10 or 100 trades is 0.5 of whatever you're risking. If you're risking 100, that's 50 per trade. Risking 200, 100 per trade, and so on. Why is this important? Because when you're looking at the mass favorable excursion, you want to see, and there are 2 ways to measure mass favorable excursion: how far it goes before it hits the stop, or how far it goes before it hits your break-even stop as well, or how far it goes by X amount of time. So there are different approaches, but let's stick to one, and mine is going to be how far it goes before it comes back to the stop. So if we take 10 trades and 5 of them go here before they go, before they go, 5 of them go to 2R before going to the stop, then those are going to be the wins. And the other 5 do whatever they do and end up, I'm a bit tired, sorry, and end up, even if it goes here but doesn't hit the target and goes here, that's just a loss. It doesn't matter what happens in this space between here and here. What matters is whether this line gets hit before this line or this line gets hit before that line upon entering. 5, as we just did, the expectancy there, 5 and 5 gives us a 0.5 expectancy. What if 8 of them, no, let's say 7. What if 7 of them do this before, and 3 of them go to here before going here? Let's plug those numbers in here. 2 times 0.3, because 30% get to the winning, get to the target before coming back to the stop. 2 times 0.3, we'll do that now. 2 times 0.3 is 0.6 minus 7 for the win, the loss rate, times 0.7 times by the 1. That means minus 0.7. And the result is minus 0.1. That means the 2R, going for that 2R is no good, because you only get 30% and the numbers don't add up. It goes below 0. So we've already gone on 8 minutes and 50 seconds. That's a taste. Maybe we'll need to do a part 2 or something in the future. But just know that those numbers have to add up and be positive. So when you're measuring how far it goes in favor before hitting stops, that's how you're going to get the sweet spot of where your target should be. Perhaps it should be 1.5 to 1, because if only 30% go to 2, but 70% of them go to 1.5, plug in the numbers and that will be positive. I will do it quickly. 7 times by 1.5 means 0.7 times by 1.5 minus 0.3 times 1, and you end up with a 0.65 expectancy, plus 0.65. So you get the gist. You need to measure how far it goes in favor and then crunch the numbers to get the sweet spot about where you need that target to be. And that's one way of managing your stop and your target. You can take the same process and crunch the numbers for the target using a trailing stop. I use the break-even stop, as I said, after it goes X in favor. If I'm looking for 2X as a target, then I'll go break even at X. If I'm looking at 4X as a target, then I'm going to go break even at 2X, and so on and so forth. So that's a longish video, the longest in the series, and that wraps up the whole 6-video series. If you do this religiously, all of the things in this video, I'm convinced, and it's working for me, that you'll find an edge and be able to slowly but surely grind out a consistent profit over time in the market. So I hope you enjoyed this series. I will be back eventually with a 7th video, which will be longer, discussing account management, because this was trade management, but in the same way we need to crunch the numbers on a macro view. If the micro view is the trade management, then the macro view is the account management, much like the Matryoshka effect. With the time frames, you also need to look at that bigger account management more so than the trade management. The trade management's important because that's what builds the long-term management. But you do need to study how you're going to go about your trading business and manage a collection of trades and a collection of results. But we'll get into that in the 7th video. That's it for now, and happy trading.